It's time for another stock review. This time, Alibaba. Didn't ever think I would do a review for this one, but yeah, it's been requested by one of my members. If you are a member of my channel and you request a full review of a stock, I'll do it. Not only will I do it, I'll produce it as a video later and it will go out, and it could be a 20-30 minute video. Please do watch it all the way through. In this video, I'm going to cover a lot of information. We're going to start off simple, and it's going to get more and more detailed as we go. Please consider subscribing to the channel. Click the thumbs up button and share it out to more people. That way you'll be notified about my content, and it will share it out to other people as well. In this video, we are going to cover a lot of information. We're going to look at the full financials of the balance sheet, the intrinsic value. We're going to look at intrinsic value, the balance sheet, the profit and loss, the inside trading, who's buying, who's selling. We're going to look at the website. You can always learn a lot from that. We're going to bring you some latest news. We're also going to look at the dividend. That's very, very important. It's now promising a dividend. Also a full back test. A lot of stuff we're going to unpack in this video. It's a very, very comprehensive review. It's the most honest review you're ever going to hear, honestly. I say that because I aim to be the most honest person on YouTube TV. I'm not here promoting, sponsored by anyone to do these reviews. My members support the channel, and I provide this as a free service. No one can get me to say anything about the stock. This is my facts, my belief of the stock, and everything I'm going to share with you now is run through our most advanced algorithmic software, which you can get a copy of, by the way. Members can get a 10% discount, which makes my membership completely free, or everybody else can get a free copy by minimum. You can get minimum like a couple of stocks a month, I think you can review on it, but my members can get a full open package and basically make my membership for free. So let's go into Alibaba. What do you think of this stock? Now, right off the bat, I'm going to tell you this is not financial advice at all. It's not intended to be, but it is what I'm doing with my money. I've had a lot of experience now. I've built my portfolio from 5,000 to nearly 60,000, just a little bit off 60 grand today in 2.5 years. So I've had some success because I live and breathe the stocks. I study it. I do my own research, and I'm sharing it with you as part of the service as my members. And you can be a member from a couple of bucks a month if you choose to do so. Right, we're talking about Alibaba. Give it a like, share the video out. Have you done it? It really helps the video. I put a lot of work into these videos. This could be a short video or a long one. I think it's going to be a quite decent length video, this one. So make sure you watch to the end because it gets deeper and deeper. We start off very easy information, and then it gets deeper. That's the way I like to do it. Okay, let's get straight into it then. Without further ado, this is Alibaba. I don't have any shares in Alibaba. I got no intention of buying any shares in Alibaba, and I'll explain why as we go down throughout the video. But not everyone knows what Alibaba is, so I'm just going to show you a very, very simple graph at first, simple chart at first. We'll do much more detail in a few moments. You can see how this is extremely volatile. Pumps all the way up, goes all the way back down. Is it good time to buy Alibaba? Well, I'll tell you now right off the bat, will never buy Alibaba. It's not for me. I don't buy Chinese stocks because there's too much manipulation. And before anyone says it, yes, there's manipulation in the United States. It's just as bad. It's done on a completely different scale, though. However, in China, things are done on a whole different level. We've seen stocks IPO for thousands of dollars, and the next day they're like 10 cents. Time and time again. I can't enter a market like that. Anyway, let's have a quick look. Start off with the basic stuff. Alibaba engages in providing technology infrastructure and marketing reach. It operates through the following business segments: China commerce, international commerce, local consumer services, Cainiao, I hope I pronounced that correctly, I apologize if not, cloud, digital media and entertainment, and innovation and initiatives and other segments. It's very much, people regard it like Amazon. It's like the Chinese version of Amazon. All right. The CEO is Yongmin Eddie Wu. I hope I pronounced that correct as well. 235,000 employees. So it's a large company and it's based out of Zhejiang. I hope that's correct. I apologize for all these mispronunciations. Founded in 1999. So it's been around for a while now. 1999. Now then, there's a worry straight off the bat. Been around since 1999 and you regard it as the Chinese Amazon. So why is it 40% maintenance? That is if you were using margin to buy this stock, it would be 40%, which is a lot. All right. It's very, very high. Now, the lowest that you're going to go to is 25%. And the highest you'll go to is 100%. So it is it's regarded on the brokerage as extremely volatile and of extreme high risk. So you need to be fully aware of that. All right. Okay. So very high risk. Let's move down and look at the market cap of the company. Now, this does not give you a valuation. We'll come on to that in a minute. This gives you how many the shares outstanding, what they're all worth today, 195 billion. That's the market cap of the company. That's what the company's worth on paper as far as the shareholder is concerned, 195 billion. Okay. Price earnings ratio, 10.85. You need to compare that to a similar business like Amazon, and you can get an idea of the price to earnings ratio. That's the price, exactly as it says, to the earnings ratio of the value of what you're getting pound for pound, whether it's a good idea or not. Now then, a growth company with a dividend stock, very unusual. Very unusual. I don't think Amazon has a dividend. I'm pretty sure it doesn't. Tesla doesn't. Apple does, but it's so small, it's insignificant. It's a growth company. This, however, is 0.96. So it's got a dividend on it. We'll come to it in a minute before you get too excited about the dividend. Average volume, 24 million. Today's volume is 9.27. Doesn't have massive amounts of volume, but it has some. And you want a company with a decent amount of volume because that will give you the opportunity to move in and out of the stock. If it's got low volume, you can be stuck in a stock and can't get out. And it could drop and you still couldn't get out. The high today is 79.77. The 52-week high is 121. You can see the volatility here. Low is 78 today, and the 52-week low is 74. So it's near its 52-week low. Okay, so very often regarded as a good time to buy. So now let's move on to the rating. Now, this is not the rating I would ever use, but we'll start simple, like I said, and get more advanced as we move down. This is Morningstar. This was done November the 16th, so it's pretty accurate, pretty up to date. Very, very influenced, though, Morningstar is. I've noticed it's bit like the banks, they always review stocks to suit themselves. That's not how I will review it, but I will share the news so you can see what's being said. 86% of 57 ratings saying it's a strong buy, 86%. No one's saying sell pretty much, hold 12%. So it's got a very good buy rating at the moment, according to Morningstar. But again, very influenced. The bulls are saying Alibaba's Chinese commerce adjusted EBITDA margin was 32.5% higher than JD Retail's 3.1 non-GAAP EBIT margin and PDD's 12.4 non-GAAP EBIT margin for the 12 months ended. That's very good. We'll come on to margins in more detail, much more accurate, very shortly. Bears, any internet company with traffic like Douyin and Tencent can enter the e-commerce space due to its low barriers of entry. And Douyin has gained market share in the apparel and beauty space. I'm going to talk about that more detail in a few moments' time about uniqueness and proprietariness of a company. I'm going to do that in a minute. They give the fair value of this stock at 128. So clearly they're saying it's undervalued. But again, not accurate. I would need to give you better information than that. Economic moat wide. Well, I'll tell you how wide that is when we look at it in more honest detail shortly. The company is making money and it is moving in the right direction. As we can see, it's beating the estimates of Wall Street consistently. Wall Street don't like it, obviously. They try to downgrade it each time, and it outperforms Wall Street. Remember, though, it's very important to note that these analyst predictions are only expectations are set by Wall Street, not the company. However, they have consistently beaten the earnings until recently. Oh, no, I beg your pardon. The most recent was estimated 212, 214. So we have slowed down a little bit recently, but nevertheless, we are seeing a reasonable, steady incline here on the earnings. That looks good. Now, let's get a sentiment of the stock. It's important to see who else is buying this stock. You want to know who you're in bed with, right? Basically. Who else is trading and investing in this company? Tencent, JD.com, we just heard that get mentioned. Meta, Disney, PayPal, and NIO. Well, other than NIO, which doesn't surprise me, it's another Chinese company. It's kind of the Chinese Tesla, if you like, or NIO. Yeah, well, one of them anyway. Other than NIO, great company. Not a fan of Disney, but a good company. Meta, very volatile, but potential growth in the future. So what you learn from this is these are the people that also own your stock. That if you buy Alibaba, you are in with people that like some risk, that like a certain type of stock. I'm surprised that Amazon is not in this list, actually. But Amazon is the sort of American version. But perhaps, like me, people that buy Amazon don't bother with Alibaba. This isn't the full list, but this is the top list. So Amazon would certainly be there, I would have thought, if it was popular with Alibaba investors. Doesn't look like it is. Now, one of the things that I use as a criteria when I'm buying a company, and we're going to come on to the balance sheet and the margins and all of that stuff in a moment, and that's the most important thing. But one of the most important things for me is I buy a company that's unique, proprietary, no one else can do what they do, and it makes them very unique, makes them a unicorn, and hopefully gives them a good moat around their company, a good margin, because there's no competition or they're crushing the competition. Now, for me, Alibaba is the Chinese version of Amazon. I think Amazon is the global dominant force in this sector, so I don't see any room in my portfolio for Amazon. I don't see any reason. Some people feel, though, that Amazon now is overpriced, which it is, and you're looking for the next opportunity to compete with Amazon. So Alibaba could be that. However, I don't like Chinese stocks anyway, because the way they are over manipulated way more than the American version. So I wouldn't buy it on that basis anyway. For me, as they have just said in that Morningstar review, they mentioned that anyone can enter this space. Anyone can enter this space, but it's not as easy as you might feel. I mean, I could set up an online shop myself, and I could start linking products in and so on and so forth. I don't actually have to own the products or have a warehouse. Of course, I'm not suggesting Alibaba is just like me selling out of my back bedroom. That's not what I'm saying. But it's easy to enter the space. It's the same reason as I don't buy Netflix. I'm a customer, but anyone could do what they do. It's the people that make the films that are unique. Netflix aren't necessarily that unique. Anyone could go, well, we'll be a Netflix. We'll stream somebody else's content. Not that difficult, all right? Like we've seen Rumble try to be YouTube. And we can stream, except they can't compete with YouTube, right? I don't see Alibaba ever competing with Amazon, but hey, what do I know? Anyway, let's move on and let's have a quick look at some news and the real financials, okay? The first thing that we want to do is go over and look, in fact, just to take a quick look at the website. Now, the website is important not just to the customer, but also to the investor. So I like to look at a website and get an indication for it. What do you think of it? Well, straight off the bat, it's an okay website. I'm going to give this a 5 out of 10. My initial impression, it's clean. Amazon can look a bit cluttered, I think, sometimes, but you know, it's okay. It's okay. It doesn't jump out and scream at me, but I'm not going to go really any more into that. We all can see how the website works. We're not going to do a website review, but it's okay. Nothing amazing there. Anyway, let's now go into the financials, and then we're going to look at the back test and the new dividend they are now talking about. So let's go into the financials, the meat and the bones of this review, why you're here and why you want this reviewed, okay? This is important. Let's look at it now. Here we go. Now, I use Alpha. I have partnered with Alpha, and I bring my members a plan which is essentially free, premium version. If you use my membership will be free if you use my referral. I'll give you the link at the end to this. Okay, so let's go into the numbers. I believe this is one of the most advanced algorithmic softwares for you. It puts everything all in one place. You can see everything around the stock all in one place, and it's done without bias. It's done on numbers and principles, not done on someone's personal view on it. Right, let's have a look at it. Here we go. What you've come here for. The base case, the best case, and the worst case. Right? Now then, the best case, we are 61% undervalued at today's current price. Good. But remember, we have to look at the intrinsic value warnings in a second to see how accurate they are. Now, we come to these figures running it through the software using the balance sheet, the debt situation, everything else, margins and everything to give us this valuation. This isn't just guessing. This isn't someone reviewing the stock with some buyers because they want to buy it or whatever. This is just numbers. Okay, so undervaluation in the best case scenario. We're not in a best case scenario. Inflation is high. We've got macro conditions like a war, several wars going on. But maybe we're turning a corner there today with what's going on in Israel today. Maybe we're getting a ceasefire. Anyway, undervaluation 61%. If we value the stock at $141, so we're changing the metric slightly, we're going to give that evaluation of undervaluation of 45%. If you're going to buy a Chinese stock, with the extreme manipulation that comes with it, you want a very, very good undervaluation because you might as well just buy the S&P and not have any of the risk. All right, and we haven't even covered the dividend payouts yet. Worst case scenario, 26%. Now, great. I'll tell you why. If I'm buying a high risk stock, base case, not worst case, base case, I am prepared to pay an overvaluation of no more than 25%. Things like Tesla and Amazon and massive companies, massive future growth, whatever, you will always overpay for it because it's track proven record. Great company. It's done very, very well. And you're going to always pay more because the stock price will grow into its valuation. People buy it because they know it's going to be in the future. So you're always going to overpay for something like that for the future. That's just the way it is. Excuse me. So we're seeing 1% more on the worst case of what I'm prepared to do as an overvaluation. So this is very, very good. From a valuation standpoint, it's very, very good so far. Right. As you can see, we're giving it all the ticks. Today's valuation, 78. The intrinsic value of BABA stock under the worst case scenario is 106.5 compared to the current market price of 78. Alibaba Group is Limited is undervalued by 26%. We've got intrinsic value is good, DCF value up 16%, relative value 34%, Wall Street targets 81%. All of this is looking very, very good so far. I have to say, looking good so far. Move on down. Valuation history. What we're looking for is we're looking at the chart here over this period of time. This goes back into 2018, a decent range. Sometimes a stock can be better value here. Remember, this is just the price. Just the price that people are prepared to pay for the stock, not necessarily the value of the company. We're looking to buy the value of the company, not the price. I buy companies, not share prices. So if we're looking at this, sometimes the fact that it may have been better value here, because at this moment in time, it had a better potential. Things were going great, and then things got worse. In this, and it's just worth noting though, just worth saying, in this particular case, it looks more obvious, but it really isn't. It looks like this is around about the best since 2018, the best valuation to buy it. So don't get sucked in. We're going, that's obvious. The price is down, so it's obviously better value. Not necessarily. Not necessarily. There are things that can drive a stock up or down and then don't exist anymore. So it does appear right now this is the best time to buy it. Okay, great. Moving along. We're now going into the financials of the company. Now then, as you can see, revenue is 915 billion, up 2% on the recent range, and that was June 29th, 2023. Then we've got September, I beg your pardon, September. So it's very recent. September, we had 915 billion. Now, Wall Street analysts are giving it a very nice growth. Not as fast as potentially S-curve. Now, if you know what an S-curve is, when a company starts and forms, it goes flat, it ramps up, and then it tails off a little bit. This was its S-curve potential. Ramp up and then slowing down. See that there, look? And now we're getting another potential rise. This is just estimate. This hasn't happened yet, but kind of makes sense because inflation's peaked. Chinese economy is in the toilet. Hopefully going to improve. Hopefully the war in Ukraine will come to an end sooner than later. I thought it will be over by now, but it's dragged on. Awful situation. So potentially the world could be in a better place a year from now. So for something like this could do well. Operating income up 7% on the most recent range. As you can see, things are moving very, very nicely on the operating income front. Net income, now we can see things dropped off here. And that's interesting to note that it wasn't 2020. If we look at March 2020, this is March 2020, and we all know what happened around the world then with COVID, and particularly in China. It took a while for things to fall off. Fell right back down here, and we've been rallying ever since COVID's kind of over. So net income is going back up again. Capital expenditure. They've been increasing their capital expenditure. They're investing in the company. But we want to look in a moment at their debt position. So very well spending on the company, but how are you doing it? With cash on the books or with debt? And debt right now is expensive, right? Cash flow also improving. Only 1% on the most recent range, but nevertheless improving. All this looks good so far. I like it, other than the fact I just don't like Chinese stocks, and I've got Amazon, or I would buy. I'm not buying Amazon now because it's too expensive. So you might say, should I buy Alibaba? Because Amazon's too dear. Anyway, that's another conversation. 1.8 trillion on assets, 777 billion on liabilities. Now, what we don't want to see is more liabilities and assets. If we do see that, then the solvency score is low and the profitability score is low and we're in trouble. All right, we don't want to see that. However, we're looking pretty good on that. I want to see how much their long-term debt is. That's what's important to me. Long-term debt, 159 billion. It's a lot of debt. A lot of debt from you and I, but 159 billion is not much out of 1.8 trillion. However, of course, it's not good to have debt, but all companies have debt. They can make more money using the money than they can saving on the interest rate, okay? And they probably get a preferred rate anyway. But of course, rates are going to go down in the spring and the summer, so that will just get better for them. If they can manage it, it's okay. Long-term debt is coming in at 20.42%. Long-term debt. Okay. We don't want debt, but it's manageable. Okay, let's now move down to the efficiency of the company. The efficiency of the company. This is what tells us how likely they are to see off the competition. Competition, of course, is Amazon, I would assume. So if their margins are quite small, then they are open for takeover, competition, and so on and so forth. The margins are 38%. Now then, I'm not going to do it right now, but you need to go and check what the margin of Amazon is. What the margin of Amazon is and see how that compares. In fact, I'm saying I won't do it. Why not? Why not do it? Because it is their competition. So let's go Amazon. AMZN. Let's have a quick look and do it live. Don't normally do this, but I will. Let's look at their margins. There you go. There's your concern right there. There's your concern right there. Amazon's margin is 46%. In other words, it can reduce price, sell less, and still make more profit, crush the competition. In other words, it's got a way of, because the company's more efficient and whatever the business, it makes more, and its margins are very, very good. So we'll go back to Baba now, and we'll compare 46%. BABA, back to Alibaba again, 46%. So its competition is quite significant, 44 to 38. It's quite significant. And their margins have been declining, but they have been investing though. So they've been spending more money, so their margins have been going down. Operating margins going down, net margins been going down. They're making margin, they're making profit. However, it's been squeezed. That's Amazon's pressure, because Amazon can afford to reduce prices. Alibaba really can't, and they could get squeezed out of the competition. That's essentially what we're talking about. So profitability will not be as good as Amazon, and maybe we should check that as well. But their solvency score probably won't be as good. So shall we look at Amazon first of all and compare? And let's see if I'm right. So we'll go AMZN. You might want to write this down. Let's have a look down and see what their efficiency is. Amazon is 52% and 59% solvency. So 52 and 59. That's Amazon. 52 and 59, which is good. Not great. Difficult sector to make money in when you're investing. But 52 and 59. Let's go back to Baba now. BABA, 52 and 59, 52 and 59. Is that how you remember things? 52 and 59. Profitability, 58 and 74. So they are in a much stronger position than Amazon. That surprises me. And if I looked at the balance sheet, I could probably find out the reason for that. It probably is because even though Amazon have greater margins, they're spending a lot more, investing a lot more, and I bet you they have more debt. And if we check that, I bet that's what we'd find. So because of that, Baba, much better balance sheet from the point of view of cash, the amount of debt they borrowed, are actually in a better solvency score, less likely to go bust. But let's put all this into context. Even though they're less likely to go bust at 59 with Amazon, Amazon ain't going bust. They're just spending more money on investing. So they have greater margins to continue to put pressure on Alibaba. That's the point, all right? So just worth noting, that sounds really great, and it is. And it is great. They beat Amazon on profitability and on solvency, but Amazon are spending more investing, so consequently they could ultimately come back and crush them. That's the plan, but you can decide whether that's right for you anyway. Wall Street analysts, this is what they say. 149% upside. Okay. Average 80% upside and 28% upside at the lowest level. I have to say, if you can get over the fact that you don't like investing, for me anyway, in the Chinese market, it looks pretty good. If I'm honest, it looks pretty good. I wanted to say, don't like it. It's rubbish. Don't want it. That's what I wanted to say, just because I'm a human being, and that's, but I'm bringing you the facts. So even though, I want to say, well, Amazon's great and Alibaba's rubbish, it's actually not the case at all. But that's the purpose of this. It's honest, all right? So it's looking good from every standpoint so far, from every standpoint. Literally, there's nothing, there isn't actually anything negative I can say about it, all right? To be honest with you. Anyway, let's now pick up some news, and I can share with you in a moment the dividend success. They're adding a dividend now. I can also share with you the back test if you'd invested in the S&P and Amazon, by the way. And I'm also going to show you the sentiment score as well, and the short interest. So we've got a little bit more to do. Let's first of all listen in here and see what we learn from this.
All of the upside that a lot of people were pegging into Alibaba was the fact that they were stripping down to 6 separate units and all of the value that would then unlock. So when you look at Alibaba now, how can one make the case that, we're going to see the 150 PTs that everyone had on them just about 3 or 4 months ago?
Yeah. So I'm going to actually play the devil's advocate here. I think if you look at Alibaba as a group, it is trading at 8 times PE today, including the profitable as well as the non-profitable units. So together, as one unit, it is already very cheap. Now, on cloud, I think if you take a step back and you think about it, the cloud decision to spin off was made by Daniel Zhang, and who has since stepped down as the CEO. He was supposed to head the unit to begin with, and he's no longer heading it now. We have Eddie coming in, we have Joe coming in, we have new management. So naturally, some of these decisions have to be relooked at. Secondly, I would argue that
as you heard there, 8 times earnings. You can't get that price for Amazon. So price to earnings is very, very good. Everything about the balance sheet so far, the debt situation, everything about it so far is good. I have to say, I can't find anything why I wouldn't want to buy it.
Giving away cloud, which is supposedly one of the crown jewels in Alibaba empire, is not really good for shareholders, especially those who are left holding whatever's left of Alibaba. And now, with the focus on AI and with cloud being the infrastructure that delivers AI services, I think having cloud in Alibaba may actually be better for shareholders.
Is it better for shareholders or is it better for Alibaba? Because, they like to knock at the door and tell everybody, 80% of businesses use Alibaba Cloud in China, especially for Gen AI services, that it's great. But now they're also warning us that, the scarcity of chips or the inability to source these chips is going to be an impediment moving forward. So the question then becomes, if this is continuing to be an impediment, what is that going to mean for their cloud services division overall? Because I would imagine that if we are to believe this AI hype and we are to believe that every company is going to be utilizing AI services, to not be able to have that kind of top-level support coming through via your cloud, which is how people would be accessing a lot of this AI processing compute, what does that mean for Alibaba Cloud broadly moving forward?
Yeah, so I think that's probably, they mentioned that as a reason why they wouldn't spin off cloud. So it's probably going to go through a period of sustained investment to invest in their AI capabilities so that it can be stronger in terms of offering those services before actually spinning it off as an independent listed company with P&L that people look at every quarter. Now, on the chip side, we've seen from Tencent 2 days ago, they also say that eventually they will face problems with the restrictions on accessing chips. However, they do have a stockpile which can last them, I quote, generations of development. I would imagine Alibaba has a similar stockpile, maybe less, but I think in the near term, in the next 1 or 2 years, it's going to be fine for them.
Okay. That's some news. Interesting point about the chips there with the AI, and we know that's the future. Everything's going that way now. Let's look at the short interest. I'll show you. It's low. Nothing significant at all. There is some short interest, but nothing to really shout about. 3.67. There's no short squeeze here at all. There is some short interest. You can get lowers, and I've seen, the big companies with I say big company, it is a big company, but Apple and stuff like that, less than 1%. So it's relative, but it's very small. It's not going to cause a short squeeze like that. So don't buy it for that sentiment. Now, before we come on to the back test, let's go back. Thank you very much, JR Cometa, for your subscription. Over the last 90 days, we were green, 52%, 26% negative. That was all. Over the last 30 days, the negativity has come in. Hence, the price has been going down and stuff like that. And perhaps the chips is an issue for the AI sector. Last 30 days, it's dropped to 30. It's 36% is negative now. It's increased. Last 7 days, 45%. It's getting more and more negative over the last 7 days. And today, we've got some good news of 50% and negative of 25%. So quite a bit of negative sentiment there around the stock, but also some good coming in today. Let's be fair. Okay, what we want to do now, our last thing we'd like to do is you've got some news to share with you, then the back test, and then also the dividend position as well. So let's go straight over to some news, literally just in a few moments ago, so I can pick this up. This is the latest information I've got for you here. Let me share this with you, and here it is. Jack Ma halts plans to cut his Alibaba stake after shares in the Chinese e-commerce giant drop. Jack Ma halts plans to cut his Alibaba stake after shares in the Chinese commerce giant drop. Let's have a little read into this. Alibaba founder Jack Ma held off on plan to trim his stake in the Chinese e-commerce giant after the share prices fell. So he's trying to protect the stock. Also doesn't want to sell when the prices are down. Makes sense, I guess. Ma has not sold a single share. Alibaba's chief people officer, Jane Zhang, told employees in an internal memo seen by CNBC. Alibaba's regulatory filings last week revealed Ma is looking to sell 10 million shares at a value of around 870 million. So obviously he doesn't want to sell his shares right now. So when the stock pops up again, then he may do so. Now, I haven't had a close look at his allocation, but I would get the impression that isn't a huge amount. And as they've said, he hasn't actually sold. And as we can actually see here, I think, do we have any share price action? Let me see if we do. If we do, I'm going to bring it to you. Inside trade. No, we don't have any information of who have sold or who has bought stock on Alibaba from an internal point of view. So there's no information there. But anyway, so I don't know his full allocation. But anyway, there we go. He's going to wait for the stock price to go up and then he'll sell, which of course could bring it back down again, which will concern people a little bit, right? Let's go into some more detail here. I'll zoom in a little bit just to make it even clearer for you. Jack Ma held off and planned to trim as the prices have fallen. Ma has not sold a single share. We've read that a moment ago. We won't cover that again. Alibaba's regulatory filings last week revealed Ma is looking to sell 10 million shares at a value of 870 million. Those plans were revealed in a regulatory filing on November 16th, the day Alibaba released its September quarter earnings. So we do know at some point that's what he wants to do. Now, that doesn't mean to say it's a negative sentiment. It just means he wants to trim his position, and that is perfectly acceptable, perfectly normal. We've got no problem with him doing that, all right? But just to put it into full context. Now then, let's go over to the last part of this. First of all, we'll look at the dividend. We've now seen that Alibaba is bringing in a dividend. Now, it's just happened. It's new. We have the information now for the first time, and here it is, declared final on the 16th of November. You're going to earn $1 per share of Alibaba. Every share that you own that's settled that you own and settled by the 20th of December. So you probably need to buy it on the 17th of December to make sure that you're settled. Normally takes 2 days. If you buy it on a Friday, of course, I don't know what day the 20th is, don't expect it to be cleared on the Monday. Anyway, you need to be in the stock to receive your first dividend. It looks like this is the first dividend ever. This is all that's on the list, so this looks like the first dividend ever. So we've got no track record. Now, if you're buying it for the dividend, you've got no dividend history. What a dividend king is, like J&J and Coca-Cola, is when they've consistently paid the dividend over a period of time and consistently increased it. This is the sort of thing that can happen, manipulation that can happen. I'm just not suggesting it is. Everything looks pretty great with Alibaba today, I have to say, but you could be in for a great dividend this time round, just to find it's been cut the next time round and you ain't going to get it again. It hasn't established itself as a dividend king, and it needs to pay out for many, many years, consistently increasing before you know it's a dividend king. Right now, its first dividend will be paid out to you for every share you own, $1 on January 18th, 2024. Okay, so we know that's going to happen. You can't buy it just for the dividend, though. It is a growth stock. We don't know. Next quarter, it could decide it's not paying a dividend, or it could increase it, or it could drop it. We just don't know. We just can't say. Anyway, our final test before I give you my final thoughts on the stock. If you'd put $10,000 into Alibaba on the in January 2015, you would now have 7,941. You would have basically lost around about 20% of your money. Okay. If you'd have put the same $10,000 in the S&P 500, which is marked here in red, you would actually be up to 23,000. If you'd have bought, and it's marked in orange, back in 2015, January 2015, Amazon, you would now be up 85,000. You would have 8x'd. Very, very good, right? Now then, we want to look at the chart as we can see it there. Clearly the winner is Amazon, then the S&P, and then we've seen Alibaba crawl along the S&P line, incidentally. Just worth noting that. It's quite interesting that it's followed that line pretty much, and then it fell away in January 21, and we saw that it was a year after COVID, which is very interesting that it fell off there. So we need to research why it did, and it's been falling ever since. When we've seen Amazon dramatically sell off, that was because of the layoffs. Well, we know why that was, because there was a warning, a price warning. Amazon cut staff. There was a big pullback. Everybody dropped the shares, and it was definitely oversold. I bought it at 100 and made like 38% profit. It was an overreaction. We've not had that reaction with Alibaba. So anyway, there is my thoughts today on my review on Alibaba. So now we're going to just close out the show with my final review and thoughts. What do you think? Okay, let's come back to that now. That's my review on Alibaba, and I have to say it looks pretty good. There are some concerns, but overall it's got a good balance sheet. Its solvency and profitability score is currently higher than Amazon. It's got plenty of cash on the books. Its debt position isn't out of control. It's looking quite good overall. If you like Amazon, and Amazon is overpriced, which it is, Alibaba probably is underpriced right now. You might like it. If you're buying it for the dividend, though, we don't know where we stand with that. For me, it's not a buy right now, only because I'm fully invested. Perhaps I could be convinced to change my mind on not ever buying Chinese stocks and buy this, have a little nibble at it and see how it feels. But for me, I'm fully invested now. My margin is maxed. I'm not looking to buy anything else. So for me, it's not a buy, but it could well be a buy for you if you are starting to invest, think Amazon's too dear, which it is, and feel that this is the way forward. What do you think? If you click above my head or below in the description, you will find the link to Alpha Spread, where you can get my software that I use, and you can get a lifetime discount, which basically makes my membership for free. Or if you look below, you'll find other links like my X account, what I'm buying, what I'm selling before I'm buying and selling it. You can check that out as well. Over here, I post more reviews. I review all the stocks my members ask me. They're honest, they're real, they're in-depth. I even leave my own personal views at the door, like I have today, and you know, said that it's actually quite a good buy, even though I thought initially I would say it wasn't. So there you go. It does look pretty good. And that's it. That's my review. I hope you enjoy it. When this video comes out, if you, whoever it was who asked for it, which I believe was, let me just have a look. It was requested by Mitch ML from the Netherlands. If you do a super thanks under the video, YouTube will promote it. If they get people liking and watching and super thanksing, it tells YouTube you like it. They will start to suggest the video, and it might pick up and more people will learn about Alibaba. There you go. Thank you very much indeed. As always, until next time, take care of yourselves and each other. Happy Thanksgiving, by the way.